Welcome to this new episode. Today, we're diving into a major tax development that's reshaping film production and studio build-out, the One Big Beautiful Bill Act of 2025, or OBBBA, and its permanent restoration of 100% bonus depreciation under Section 168.
Yeah, it's a pretty big deal, especially for companies like NuFangled TV. The OBBBA not only brings back the full immediate expensing of qualifying assets, but also removes the old $15 million cap on film production expensing and expands eligibility to include sound recording productions. So it's really changing the game for tax planning in the entertainment space.
Absolutely. And in this episode, we're going to unpack the legislative changes, how they apply practically to film and studio activities, and what strategic and compliance considerations experts need to keep front and center.
Right. So maybe we start with a quick recap of the legislative background and how the OBBBA fits into the bigger picture of bonus depreciation history.
Good idea. So, bonus depreciation was originally introduced after 9/11 as a stimulus measure, starting at 30%, then fluctuating over the years. The Tax Cuts and Jobs Act of 2017 really expanded it to 100%, including used property for the first time, but then it started a phase down beginning in 2023 to 80% in 2023, 60% in 2024, and down to 40% in 2025.
Right, but then the OBBBA, enacted on July 4, 2025, flipped that script. It retroactively restored the 100% bonus depreciation rate for property acquired and placed in service after January 19, 2025, and made that rate permanent. So no more phase downs or sunsets to worry about.
Exactly. That permanence is huge for tax planning because it removes a lot of uncertainty. Plus, the IRS issued Notice 2026-11 in January 2026, which provides interim guidance. It basically says taxpayers can rely on the existing TCJA era regulations, but swap in the new OBBBA dates and percentages.
And that notice is effective until the IRS issues proposed regulations, so it's the current roadmap for applying these rules. But taxpayers have to apply it consistently, across all qualified property, and document their reliance carefully.
That's a key point. Now, moving on to how the OBBBA integrates film production and sound recording into Section 168. Before, Section 181 allowed expensing for qualified film and TV productions, but capped at $15 million. The OBBBA folds those provisions into Section 168, removing the cap entirely.
And it also adds sound recording productions as qualified property, effective for productions commencing after July 4, 2025. So NuFangled TV's music-integrated content, podcasts, and audiobooks now get the same 100% bonus depreciation treatment.
The 75% U.S. compensation test remains critical here. At least 75% of the total compensation for services in connection with the production must be paid for U.S.-based services. That's a big compliance point.
Yeah, and production costs are treated as 3-year MACRS property eligible for 100% bonus depreciation. But, and this is important, the deduction is taken in the year the production is placed in service, meaning the release or broadcast year, not as costs are incurred.
That timing nuance can create cash flow challenges. Productions often spend years and millions before release, so the deduction is deferred until then. For example, the report mentions a $20 million streaming series started in mid-2025. $3 million in equipment gets the bonus in 2025, but the $15 million in production costs only get the bonus in the release year.
Right, and marketing and distribution costs generally don't qualify for bonus depreciation, so those have to be tracked separately.
Documentation is key, especially to support the 75% U.S. compensation test and the placed-in service dates. Payroll records, contracts, and production timelines all need to be airtight.
Definitely. Now shifting gears to studio build-out and construction, which is a bit more complex. Buildings themselves have a 39-year recovery period and don't qualify for bonus depreciation, but there are exceptions.
Qualified Improvement Property, or QIP, is one of those exceptions. It covers interior improvements to non-residential buildings placed in service after the building's initial service date. QIP gets a 15-year recovery period and qualifies for 100% bonus.
And for studios, that includes things like soundproofing, acoustic treatments, HVAC upgrades for sound stages, lighting grids, interior walls, flooring, green rooms, and fire suppression systems. But it excludes building enlargements, elevators, structural framework, and exterior facades.
Then there's tangible personal property installed during build-out lighting rigs, camera mounts, servers, furniture, and land improvements like parking lots and landscaping, all eligible for 100% bonus.
The report stresses the importance of cost segregation studies here. They're engineering analyses that break down building costs into shorter-lived property classes, increasing the amount eligible for bonus depreciation by 20 to 40%.
Yeah, it's like taking a big building and slicing it into pieces that can be depreciated faster. And timing matters. These studies should be done during construction or renovation, not after completion.
Then there's the new Qualified Production Property, or QPP, under Section 168. This is a temporary 100% bonus for qualifying production facilities, including new construction integral to qualified production activity.
But there's ambiguity about whether film studios qualify as QPP because the IRS might view film as intangible, not tangible personal property, and might narrow the definition of manufacturing.
So NuFangled TV should definitely consult tax counsel, document their production processes carefully, and maybe even consider private letter rulings before claiming QPP treatment.
If qualified, QPP allows full expensing of the entire building, not just improvements, which would be a significant benefit.
Moving on to acquisition and placed in service rules, for bonus depreciation eligibility, property must be acquired and placed in service after January 19, 2025.
For purchase property, acquisition means entering a binding written contract on or after January 20th, 2025. The contract has to be enforceable and can't have escape clauses that undermine its binding nature.
For self-constructed property, acquisition occurs when significant physical work begins, or when at least 10% of the total cost is incurred, the so-called 10% safe harbor.
For film productions, principal photography's start date establishes acquisition, and placed in service is the initial release or broadcast. For sound recordings, it's fixation of sounds and commercial release.
Used property qualifies if it hasn't been used by the taxpayer or predecessor, was acquired in an arm's-length purchase, and not from related parties.
There are also special rules for long production period property, like certain aircraft, which extend acquisition dates.
Now, about elections and strategic use. Taxpayers can elect out of bonus depreciation for any class of property under Section 168. This election is irrevocable without IRS consent.
That's useful to manage net operating losses, AMT exposure, or unfavorable state tax outcomes. For example, if a big bonus deduction would create an NOL that can't be fully utilized, electing out might make sense.
There's also the reduced percentage election for 2025, allowing taxpayers to elect 40% bonus instead of 100%, or 60% for long production period property. This applies to all qualified property in the year.
That can be strategic if a taxpayer has limited tax liability or wants to spread deductions over multiple years.
And then there's Section 179, which allows immediate expensing up to about $1.16 million, but it's income limited. Bonus depreciation has no income limitation and is unlimited in amount.
The strategy is to apply Section 179 first to property ineligible for bonus, like used equipment from related parties, then apply bonus depreciation to the remainder.
State and local tax considerations are another big piece. States vary widely in conformity to federal bonus depreciation.
Right. Some states fully conform, adopting federal bonus automatically. Others, like New York, have partial conformity and require add-backs. And California is a major nonconformity state. It disallows bonus depreciation and requires add-backs on state returns.
For California, that means NuFangled TV must reverse federal bonus amounts on their California Schedule CA and use regular MACRS depreciation instead, creating significant book tax differences.
New York's rules are complex too, with add-backs for bonus depreciation exceeding certain thresholds, plus New York City's own tax regime.
Other states like Georgia and Louisiana generally conform and offer strong film production tax credits, which operate independently of federal bonus depreciation.
So NuFangled TV should maintain detailed multi-state depreciation tracking systems to manage add-backs and deferred tax accounting accurately.
And importantly, state film tax credits are generally not reduced by federal bonus depreciation, so taking the full 100% bonus doesn't jeopardize those credits.
On interaction with other tax provisions, Section 163 limits business interest deductions to 30% of adjusted taxable income, or ATI. Bonus depreciation reduces taxable income and ATI, potentially limiting interest deductions.
So, electing out of bonus on some property might increase ATI and allow more interest deduction. But real property trades can elect out of 163 only if they use the alternative depreciation system, which eliminates bonus eligibility.
Net operating losses are another consideration. The 100% bonus can generate large NOLs, which carry forward indefinitely but are limited to 80% of taxable income in carry-forward years.
So, strategic planning is needed to avoid wasted NOLs, especially if future income is uncertain.
The corporate AMT was repealed post-TCJA, but the new Corporate Alternative Minimum Tax, or CAMT, applies to very large corporations. Most production companies won't be affected.
For energy credits, bonus depreciation reduces asset basis, which can affect credits like the investment tax credit under Section 48. So if a studio incorporates solar or other clean energy, that interaction needs careful analysis.
And if NuFangled TV changes accounting methods to claim retroactive bonus depreciation, they must file Form 3115 and recognize Section 481 adjustments.
On compliance and documentation, Form 4562 is critical for claiming bonus depreciation and elections. Detailed production cost documentation is essential, especially for the 75% U.S. compensation test.
Maintaining fixed asset registers segregating bonus-eligible property, QIP, and non-qualifying property is a must. Cost segregation studies also need thorough documentation.
Election statements must be timely and properly filed. And given the complexity, IRS scrutiny is expected on key areas like the 75% test, placed in service states, QPP eligibility, QIP classification, used property acquisition, and cost segregation.
So, engaging specialized tax counsel and maintaining well-organized electronic files is highly recommended.
Finally, the report offers strategic recommendations for NuFangled TV. Accelerate capital expenditures on qualifying equipment and QIP to maximize immediate deductions.
Commission cost segregation studies on all major studio projects to reclassify costs and increase bonus eligibility.
Evaluate QPP eligibility for new studio construction carefully with legal counsel.
Implement state conformity tracking systems to manage multi-state tax differences.
Coordinate federal bonus depreciation with state film tax credits to optimize overall tax benefits.
Monitor the 75% U.S. compensation test continuously during production to avoid losing qualification.
Conduct annual NOL position reviews to ensure bonus deductions generate real tax savings.
And stay alert to forthcoming IRS proposed regulations and adjust tax positions accordingly.
So to wrap up, the OBBBA's permanent 100% bonus depreciation is a powerful tool for film and studio tax planning, but it comes with complexity, especially around studio construction and state conformity.
NuFangled TV's ability to leverage these provisions depends on meticulous documentation, strategic elections, and proactive multi-state tax management.
And with the regulatory landscape still evolving, ongoing vigilance and expert advice are essential.
Well, that's a lot to digest, but hopefully this gives our listeners a solid foundation to navigate these changes.
Definitely. Thanks for joining us today. We'll keep an eye on developments and bring more insights as they come.